Okay, let's unpack this. Today, we're setting up a kind of conceptual debate between two uh, absolute giants of economics.
Hmm.
In one corner, you've got Adam Smith, the 18th century father of economics,
Hmm.
with his, foundational rules for a stable economy.
And in the other, Thomas Piketty, the modern wealth critic whose work in the 21st century really challenged our whole idea of meritocracy.
It's a showdown separated by centuries, but the core issue is, well, it's exactly the same.
It is. The question is, how and maybe how aggressively should we be taxing capital to both fund the government and, keep society fair?
Right. And our sources lay out the arguments from both sides. What you're going to walk away with today is a really clear understanding of this fundamental friction.
The friction between classical ideas of economic growth and the modern push for wealth distribution.
Exactly. It's the fault line under pretty much every tax debate that's happening right now.
So we'll start with Piketty's diagnosis. I think we have to understand the problem he sees in our economies first. Then we can pivot to Smith's foundational response.
His kind of practical rules for how you do taxation responsibly.
Exactly. They serve as a sort of warning label on any big tax reform.
Let's jump straight into Piketty's argument then, because it all starts with just four characters. A formula that has become maybe the most famous in modern economics.
That formula is the intellectual engine of his whole book, Capital in the 21st Century. It's simply RG.
It looks so simple on the page, but what does RG actually mean for, for an individual trying to make a living?
Well, it's his central observation about how wealth works. The R stands for the rate of return on capital.
So what you earn from investments, stocks, real estate, that kind of thing.
Right. And G stands for the rate of economic growth, the growth of the whole economy, like GDP.
So if R is consistently bigger than G, it means that existing wealth, it just grows faster than the money you can earn from a job.
Precisely. So say the economy is growing at, 2%.
Okay.
But a big portfolio of inherited stocks is returning 5 or 6% every year. That means the owners of that capital are pulling away from everyone else.
And it's not by chance. It's baked into the system. Piketty says this is basically the default setting of capitalism.
Yes, unless it's actively countered. And the biggest consequence of this RG dynamic is that wealth naturally concentrates at the very top.
Which leads to what he calls a hereditary aristocracy of capital.
An incredibly provocative phrase.
It is, because it just flies in the face of the idea of meritocracy. It suggests that what you inherit becomes more important than what you earn.
Exactly. And he says the mid-20th century, when we saw more equality, that was the exception, not the rule. It was an aberration caused by 2 world wars and the high taxes needed to pay for them.
So if RG is the engine of this inequality, how does the tax code help it along? Piketty says it's because the wealthy earn their income differently, right?
Yes, they earn through capital, not labor.
Yeah.
You or I pay our highest tax rate on our salary.
Our labor income.
Right. But the wealthy get a huge portion of their income from capital, and those streams are often taxed at much lower preferential rates.
And he specifically targets things like capital gains and dividends. But there's another one he talks about, carried interest.
Carried interest is a perfect example. It's basically the cut that investment fund managers take for managing other people's money.
Yep.
But it's often taxed as a capital gain at a lower rate, not as the ordinary income it really is.
So $1 earned managing a hedge fund is taxed less than $1 earned being a teacher or a nurse.
That's his point. And his proposed solution is pretty direct. Align the tax rates on these capital streams with ordinary income.
To stop what he calls the slow death of meritocracy.
His bigger vision is even more ambitious, a global tax on wealth itself. But even just aligning the income tax rates is a huge challenge to the current system.
Okay, so Piketty's focus is clear.
Yeah.
Fix this structural problem. But this is exactly where he runs into the, let's call it, the brick wall of practical governance laid out by Adam Smith 250 years ago.
It is. But first, we should probably admit where they'd actually agree. Smith, in The Wealth of Nations, gives a moral justification for taxes that Piketty would absolutely get behind.
He wrote that the subjects of every state ought to contribute towards the support of the government as nearly as possible in proportion to their respective abilities.
That's the bedrock principle of proportionality.
And he even went a little further, adding a nuance that sounds, well, it sounds pretty progressive.
It does. He wrote, it's not very unreasonable that the rich should contribute something more than in that proportion.
So even the father of economics thought the wealthy should pay a bit more than just a simple flat rate.
He did. But, and this is the huge but, Smith wasn't just concerned with fairness. He was obsessed with whether taxes actually work.
Their functionality. And this is where he issues his big warning. Piketty wants to raise taxes on capital for equity. Smith says, hang on.
Your tax has to follow these unbreakable practical laws. These are his famous canons of taxation. For Smith, a tax that seems fair but wrecks the economy is, by definition, a bad tax.
And he said good taxes have to be, what were they? Certain, convenient, and efficient.
That's it.
Okay, let's dig into those for a second. We always talk about efficiency and capital flight, but what did he mean by a tax needing to be certain?
Certainty was, for Smith, a defense against tyranny. The amount you owe, when you pay it, how you pay it, all of it must be crystal clear to the taxpayer.
No ambiguity.
None. If the rules are arbitrary or vague, it invites corruption and the state loses trust. Trade just dies.
That feels incredibly relevant today with our complex tax codes. Okay, and what about the third canon, convenience?
Convenience just means the tax should be collected when and how it's easiest for the person to pay. Think about income tax coming right out of your paycheck.
You don't have to save up a big lump sum.
Exactly. It's convenient. Smith thought taxing sales was less convenient than taxing something like rental income because the cost gets passed on to the consumer in a messy, hidden way.
Okay, so we have certainty and convenience, but now we get to the big one. The one Piketty's plan directly challenges efficiency.
Right. And for Smith, efficiency was all about the nature of capital itself. He was very concerned about what he called the nation's movable stock.
Movable stock, unlike land, which is fixed in one place.
Exactly. Capital money, investments, liquid assets is highly mobile. Smith warned that if you tax that movable stock too heavily, it will be driven to seek refuge in other lands.
That makes total sense, especially in the 18th century with global trade just starting to explode. But this wasn't just about protecting rich people's fortunes, was it?
Not at all. That's the key point. The real consequence of that capital flight is what happens to the domestic worker.
Ah.
If the capital leaves, Smith argued, the local laborers are left without the tools of industry. No investment means no new factories, no new machines, no innovation.
And there it is. That's the core tension, perfectly laid out. Piketty sees the system as it is and says, look, high capital accumulation is starving labor of opportunity because of inequality.
And Smith looks at high taxes on capital and says that policy is what starves labor because it removes the very tools they need to be productive.
So Piketty sees high taxes as the cure for a structural disease, RG.
While Smith sees those same taxes as a potential disease themselves, one that could choke off the economy by violating his principles of efficiency and certainty.
So where does that leave us today trying to navigate this? Let's try and synthesize these two views.
I think the main takeaway is that Piketty and Smith are really highlighting a zero-sum policy trade-off.
You can't have both.
It's very difficult. Piketty is prioritizing equity to fight RG. Smith is prioritizing efficiency and certainty to ensure growth and stability.
So we have to ask ourselves, is Smith's 18th century fear of capital fleeing still our biggest threat? Or is Piketty's 21st century fear of a new hereditary aristocracy a greater danger to society?
And technology just makes it all more complicated. Think about Smith's rule of certainty. What does certainty even mean when capital can be held in offshore accounts or digital currencies or these incredibly complex international trusts?
It's a great point. Smith expected capital to move, but not with the speed and the invisibility it has today.
And if capital is invisible or can move instantly, that doesn't just threaten Smith's idea of efficiency because it can flee.
It also threatens Piketty's goal of equity, because you can't even find it to tax it in the first place.
It's a double whammy for any government. You know, if Smith were here today, he might even concede that Piketty's idea of a global capital tax is the only way to solve a global RG problem.
But then he'd immediately follow up with a warning.
He would. He'd say that without absolute global certainty and convenience in applying that tax, the capital won't just flee, it'll just vanish into jurisdictions designed to hide it.
And a unified global tax seems, well, politically impossible right now.
Yeah.
Which brings us back home. If we try to tax capital gains highly in one country, Smith's warning about capital flight just feels unavoidable.
It does. Which means any policymaker trying to solve Piketty's problem has to constantly be thinking about Smith's warning. They have to design something that raises more from wealth without triggering a mass exodus of capital.
And we're left with this fundamental policy challenge. We agree the wealthy should contribute more. Even Smith said they should pay something more.
Right.
But is something more enough to fight the structural force of RG? And if we push for real alignment, do we break Smith's rules and cause the economy to stagnate?
It really comes down to which risk you think is more dangerous. Is it the slow, grinding risk of severe inequality that Piketty warns about? Or is it the more immediate risk of economic contraction from lack of investment that Smith warns about? Both are pretty devastating outcomes.
So this deep dive has really given you the framework to understand this entire debate. You now have the meaning of RG, the threat it poses, and this essential tension between equity through tax alignment and the efficient certain structures that Smith demanded.
And we'll leave you with a final thought to consider. If we accept Smith's warning that capital will always flee uncertainty, and we accept Piketty's data that RG is real, does that mean the whole problem of global inequality needs a solution that, well, that doesn't rely on income taxes at all? Maybe we need to reinvent the very mechanism of taxation to satisfy both that demand for equity and the need for certainty.
That is a great question to take with you. Thanks for joining us on the deep dive. We'll see you next time.